financial argument. Follow us on YouTube.
And I reached out to David Morgan here this week following the Fed's decision. David Morgan, of course, of the Morgan Report, precious metals expert. He's been on the show before. And, there's a lot of opinions flying out around now regarding, the economy good, the economy bad, what to do with precious metals. And I really wanted to get someone on the line here who has his pulse on the markets. David Morgan, thanks for joining me.
My pleasure. Thanks, Kenneth.
David, following the Fed's non-decision to keep rates the same, precious metals actually did go up, and it was loose monetary policy, and of course that's bullish for metals. However, going into the rate decision with such low expectations for them actually raising rates, the consensus was, they weren't going to raise rates. No one was expecting it. I personally believe that if they did raise rates, there would be such a shock to the markets that we would actually see precious metals go up regardless, kind of like what we saw in Brexit with the vote shocking the markets, the stock markets getting volatile, and gold going up $100. So, just starting you off with that, what are your thoughts on what the Fed did this week in precious metals?
Well, I can't agree with you. On the release of the Fed statement from Wednesday evening, gold jumped to a spot high of about $13.36 an ounce, and silver moved up substantially as well, just under $20, about $19.87. And I had thought perhaps that the market, the precious metals market, had anticipated the announcement of not raising rates. Obviously, based on the action of the metals prices, I was incorrect. But adding on to that, I think that we're at a point, as you stated, that could move up regardless. The idea being that both the Bank of Japan that announced on that same day that it would target interest rates on government bonds in order to achieve the inflation target, then reassured the markets would continue to buy large amounts of bonds and riskier assets. However, the bond market's starting to get away from the Japanese right now. And what we know, but hasn't really manifested in a very long time, is that the major central banks can set the discount rate or the rate of their primary borrowers, but they cannot really set the overall amount of volume or trading in a government bond, which means that ultimately the interest rate is set by the market. Now, we all know, we all know these markets are managed a great deal, and more than any other, the interest rate markets, the bond markets. And these are set by central banks on a global basis for their own benefit. They're not market-driven as they should be. However, Japan, again, I'm repeating, has experienced where the interest rates start to come up, which means that the bond prices are going down. And this is the biggest fear that the central banks have, that they're in a box. They don't really have the ability to move interest rates substantially higher on their own, although they could. But any little tweaking in interest rates at this point in time causes problems. The first problem it causes is with the central banks themselves, because the interest rate determines the ability of the debt to be serviced. So if you have a credit card at 18%, the payment is a heck of a lot higher on the money you borrow than if the interest rate is at 2%. Of course, governments are in the same situation. So if interest rates are high, not only do their bond values go down, but that it makes it much more difficult than it already is to try to service the debt. And this, again, is one of the greatest fears. So they really can't raise interest rates substantially, although it's jawboning and talking to markets. The other, I think, more salient point is simply this. As much as we focus on interest rates, that's the nominal rate. That's the rate in the marketplace, regardless of how it gets there. But until we get to what the true rate is, above and beyond inflation, we have a nominal rate that is not commensurate with or identified with the actual real rate of return for someone that invests in a bond. So we have an inflation rate of, let's say, 2%, and interest rates are below that nominally, you're actually losing money by being in the bond market. And of course, now we're in this ridiculous situation where there are negative interest rates, which means regardless of what the interest rate is stated on the bond when you purchase it, you are guaranteed to get less money back than what you invested, which is absolutely preposterous. Yet this is taking hold, throughout many of the major nation states, sovereign nations that issue their own debt. So we're in a situation never experienced before in monetary history, at least recorded history, and it's not working out well. And they really don't know what else to do other than the other idea that they can talk to the markets and basically get the psychology of the markets to favor their quote-unquote policy decisions that can control not only the interest rate situation, but also put a damper on, let's say, the key assets that will work against them, which would be something sovereign that's outside of their control, which of course is the gold and silver markets. I say out of their control from a longer-term perspective, which means that there are enough people that purchased physical metal that at some point they basically would lose control. And we've experienced that already in the 2008 crisis. And we've seen that pop up a couple of times beyond that. But it hasn't gotten to the point, it hasn't gotten to the point where we have seen it manifest, day after day, week after week. And that potentially lies ahead of us. In fact, I have held that strong belief for a very long time that at some point the physical marketplace would overtake the paper paradigm that controls the price of the metals.
David, you pointed something out, and we know that it's all about controlling the psychology of the markets, and they're desperately trying to do that with their job owning and the statements that they make. But also, you pointed out Japan losing control of interest rates, and interestingly enough, they were the ones who kind of led the way with QE and ultra low interest rates for the last couple decades here. And I'm wondering, and I'm sure you were alluding to this, but I'd like you to reiterate, I guess what we're seeing in Japan is ultimately what's going to trickle into the rest of the world with interest rates, losing control of the bond market.
Yes, the bond market is key. There's nothing more important than the problem, and the problem is too much debt. And when the value of the debt starts to move in the direction of what its true value is, then interest rates move higher and perhaps substantially higher. The game basically ends. There isn't a lot of control. They meaning the central banks on a global basis, Federal Reserve probably leading the party, perhaps the World Bank and the IMF would come in also. We already have witnessed this a great deal already, where the buyer of last resort, of course, are these privately owned central banks, and they will, because they have an unlimited checkbook, prop up these bond markets, but it could get beyond their ability to control it. In fact, it really is. If you really examine what's happened, if their policy of this Keynesian idea that they can stimulate the economy by having low interest rates and that stimulates economic activity, if that were true, then, once QE1 was enacted, we'd be on our way to a substantial recovery. But it didn't work, even though the mainstream press told us it did. So what did they do? They implemented QE2. And what did that do? Well, QE2 was actually a turning point in a very interesting way. When QE2 was announced, it was roughly at the $26 level, and it moved from 26 to roughly 48, basically from the day that the Federal Reserve announced QE2. And this was anticipation by the marketplace that this increase in the money supply would substantially roll into noticeable inflation in the everyday markets. In other words, mom and pops, populace at large. People see inflation at the store. They see it in gas prices. They see it across the board, basically. And that anticipation moved silver and gold substantially higher. However, what happened was, although the market was flooded with a great deal more quote-unquote money, it did not get into the general populace. It stayed within the banking system. So what's taken place time and again through QET, Twist, and all these other operations through the Reserve, the European Central Bank, Japan, and others, is that the money is just basically sitting there doing nothing other than getting leverage through the system and guaranteeing these banks a huge rate of return and not doing anything in the general economic situation on a global basis or a nation-state basis. So money has to be looked at, and put money in quotes, not precious metals, but currency. When it's sitting in a vault, it's as if it's not in existence to the general populace. So you can inflate the money supply a great deal, which as an Austrian, that is the definition of inflation, increasing the money supply. That's irrefutable. That has taken place and continues. However, what the conundrum is that it really hasn't manifested in the marketplace where people see it. Japan's saying, well, we really want higher inflation than we have right now. Janet Yellen's data-driven, and they want to see more inflation, which, be careful what you wish for, you may get it, because this is a pent-up situation where at some point it will manifest in the bond market itself, where people holding bonds or nation-states holding each other's bonds, or these banks that have great exposure to bonds, or large insurance companies or pension funds, or all these entities that hold all this sovereign debt, start to question what the true value of these holdings are, realizing that these debts cannot be serviced even at negative interest rates, and that they will decide for their own benefit that it's probably time to unload something at a high price, because bonds are priced very high. I think we've finally seen the top of the bond market, but that remains to be determined. But once the selling starts, it could get out of hand. And then again, the central banks will come to the rescue, and they'll try to mop up or sop up the amount of selling that's going to take place. But in that, the chances are pretty strong that interest rates themselves will start to move up. In other words, as a metaphor, it's very similar to the overused metaphor about the emperor has no clothes. Everyone standing there watching the parade knows that the king's clothes can't be seen, but it's the little boy that points it out in a loud voice saying the emperor has no clothes. The bond market has no wealth. The bond market has created a paper paradigm of such magnitude, controlled by all these interest rate swaps in the derivatives markets, that it's so convoluted, it's so complex, and has to be dealt with in almost a non-stop fashion in the global market, with what happens in the overnight interest rates and what banks do with each other to maintain their reserves at a level that are dictated by law. That the convoluted nature and the amount of effort, time, and energy that's required to keep this thing going is getting to a point of exhaustion. With my engineering background, one thing that you learn about nature is that everything has a limit. No tree grows to the there's no such thing as infinite wealth. You cannot print until things get better. They've tried that. Things have not gotten better. They've gotten worse. At some point, it exhausts. And when it exhausts, you start to see a contraction. And we're definitely seeing a contraction in the global economic system. The physical economy has been contracting for quite some time. What we haven't seen is the bond market reflect that contraction, although I could argue that we're starting to see it in Japan, and that is probably the precursor for what will happen in other nation states. So we're in a situation we've never been in before. If you check my early work in the early 2000s, I said that one of my main concerns was that this is the first time in history where it's a global situation. In other words, this is going to affect just about everyone on the planet, because the reserve currency of the world is the U.S. dollar, and as the dollar goes, so goes everyone else, more or less. Now, Of course, China has started the AIIB, and they've moved themselves outside the SWIFT system. Russia and other countries have done settlement outside of the U.S. dollar. And very interestingly, excuse me, at the end of this month, China's Yuan will be accepted as part of the special drawing rights for the IMF. And this has been probably talked about more and written more by Jim Rickards than anyone else. And he points out, and I agree, that this could be a solution. I'm not sure that it will be. And if you read his book, The New Case for Gold, he also admits that. However, when you have a central bank that has no populace to have to service the debt, in other words, the debt service on a national debt is owed not by the government. The government's the ones that got the people into the debt, and it's the people that are responsible to pay back the money, the government. A lot of people don't understand that. They think the government is this entity that controls the ability to pay back. No, it's that basically the populace that's on the hook to pay it off, not the government. The government really doesn't produce much at all other than misery. But beyond my political views, so we're in a situation again where I think we're near or at the tipping point. It's very difficult looking in the present to know the future, although you can project and anticipate and forecast, and I've done that for years. But it'll only be looking back where some historian or monetary historian will look back and say, yes, when this took place in Japan, that was the beginning of the end. This is when nation states' sovereign debt started to be questioned and the sell-off began. But we're not there yet. But we could anticipate that is not only has it begun, in my view, my strong view, but that it will continue to manifest, and probably I expect to see something more significant in that realm before the end of this year.
You know, such a lot of converging events. You brought up the Chinese yuan and the SDR. I want to get your thoughts here on gold and silver seasonality going into fall. We know what happens with the demand that comes from the Far East and India. And what are your thoughts here with precious metals as we enter the fall and, you know, a period when a lot of people are talking about a big market crash? And, you know, historically, October has been a very volatile time when we have seen big moves in the stock market.
Well, that question is one that's very much on the minds of people. I mean, our website members have the ability on the premium service to ask me 2 questions a month, and I would always guarantee they'll get an answer. Sometimes it's private, sometimes it's in the report itself for everyone's benefit. But that question was asked by a great number of our website members, and I assured them that if there is a large stock market sell-off, that the resource sector would sympathize with the general sell-off. Most of the large holdings of resource stocks are held by mutual funds, some pension funds. In other words, they're large money managers for the most part. And these people do not really have any philosophical attachment to gold and silver. A few may. But if they start seeing the market sell off in a substantial way, they'll sell anything that they can that's very liquid. And gold would be one of the most liquid things you could sell in any form, meaning physical, ETFs, or resource stocks. And they will sell those. We've seen that time and time again. And so I would anticipate a sell-off in both the mining shares and also see the gold and silver prices come down. And the reason I expect that would be because of the paper paradigm, the amount of leverage that's in the system through the futures markets, the options markets, the ETFs, and these paper paradigms that have a substantially greater amount of gold on paper than exists in reality. So because that is such a huge supply of that, you would probably see a sell-off. There is a possibility that if the market was scared enough and the decline was so substantial that we could get to a situation where gold might go the opposite direction. Kenneth, I know you haven't followed me as long as Daniel has, but early on when I started on the speaking circuit, I used to almost always preface my talks with a short film clip. And in the early days, I brought a film clip about the movie Rollover. And in that movie, the Arabs got scared and decided to pull their money from the Western banking system. And in that scenario, the stock market started to fall off substantially. In fact, to kind of reiterate it, this, you can look it up on YouTube. I think it's called Currency Crisis. Type in Currency Crisis, David Morgan. You'll get kind of my maybe hammed up. I was pretty emotional at the time I filmed for this, but I talked about what was said in this film clip. But basically, a large bank, New York bank, the floor trader gets the message that the Arabs are selling everything. So he calls everyone. They all put down the phone, and it's dead silent. And he says, the Arabs are taking everything out of our bank, and it's not just our bank, it's across the board. Currency, no positions. So the first thing he tells them is that don't play in the currency markets. And my add-on to that would be that there's no way to tell which currency is going to come out stronger. And he talked about the parameters of money that they could borrow and that type of thing. Then he goes on to say, sell whatever we have. And then he said, gold, grab what you can get. So in that scenario, which isn't all that far-fetched at this point in time, gold continued to move higher while the stock markets and the bond markets were crashing. Interest rates were spiking higher and higher, and the stock market and the bond markets were going through a crash, and that is a scenario. So could it be where in the realm of reality, what we're a real world today, where there was a huge sell-off, and the bond market and the stock markets are very heavily correlated today, whereas if you go back 30 or 40 years, they were uncorrelated. I mean, the stock market moved opposite the bond market and vice versa. That's no longer the case and has not been the case for a very, very long time. So a fact is that gold is the most negatively correlated asset, physical gold, to the stock market itself. It's outside the jurisdiction of the electronic broker settlement system, and it's money in and of itself, and it is tangible wealth and valued as money for, say, 5,000 years or so. So it's possible that we could see gold hold its ground and actually move up. However, with the recent data that we have from 2008 and other sell-offs, the reason I want to bring up the rollover movie and the possibility that we could get a huge sell-off on the stock market and maybe into the bond market, or perhaps both at the same time, is that what we have seen on these, what I call orchestrated sells, have not been working of late. The large amount of gold that was sold on the paper markets drove the price down fairly significantly for a very short time, and the market came back significantly. And that also took place in the silver market a couple months previous. So what we normally would see, and normally in quotes, what we were witnessing for a very long time, is in the access markets, what we call the overnight markets, or the smaller volume market, these large quantities of paper, gold, and silver would be sold, and that would roll over in through the New York markets, and on the open of the New York markets, there'd be a huge follow through the downside. Margin calls would start. That would get more selling, and you get these huge waterfall declines. But again, to repeat, it's very important to understand this. We've seen the beginning of that, and it stops almost not instantly, but within the same day or the next day. So it must give the sell side concern that they don't have nearly the amount of power that they had, let's say, a year ago. And this is a situation that actually is a setup for a short squeeze, especially if the physical market is much tighter than the price would indicate at this point in time. So coming full circle to what I expect on a seasonality basis, I think that we had seen a lot of new buying or savvy buying from the beginning of the year for probably a good 6 months into 2016. I'm a little hesitant to say that we're going to see a strong seasonality in the September time frame due to the wedding season and what usually is easy to forecast. Not that it'll be declined, but I think that we need some more new buying, and I'm not sure where that would come from at this point in time. Certainly, fear will trigger it almost instantly, but we don't have that in the market yet. That's a market-driven event. I also would like to point out that the last couple of months of the year used to be a very strong seasonality. You could buy the precious metals going into January and almost always be assured of a profit. And that has not been the case for the last, I think, 4 years or so. In fact, the lowest print, the lowest price for gold and silver has usually been on the last trading day of the year. And this is easy to orchestrate because a thin market or a low volume market is very easy to control the price. If you only have to buy 10 shares of a stock to move the price up or down, that's a very thin market. That's an example of what takes place near the end of the year because most traders are on vacation. They've closed their books or just going to take a holiday, and there aren't many trades made. And so the ones that are made have a great deal of influence over the price. So this, again, is what's taken place. So the seasonality has been reversed for the last 4 years or so, where we see lows going to the last trading day of December, whereas usually by that point in time, we start to see the prices of the precious metals get stronger and stronger. So I think we are obviously, it's a fact, it's not my thought, that we're going sideways right now. We're consolidating, we're in a trading range. And until that trading range is broken, no one really knows which direction we're going to go for the next, let's say, few weeks or months. If we break through to the upside, obviously there's a very strong bull market, and will probably continue to the end of the year. However, if we go sideways and we see this trading range break to the downside, then the more likely event is that a lot of these algorithms that are based on price, volume, will move to the downside, and we'll see some type of sell-off that's greater than what we've witnessed so far. And I still don't think it would be that significant. And I've given my ideas as far as support levels for both silver and gold markets to the website members. But for the general audience, I don't think there's a lot to worry about, especially if you deal in physical metal only. It probably wouldn't be that significant of a decline. I really, looking at the data and trying to be objective, know that the markets are trading in a much different fashion this entire year than they have in a very long time.
Absolutely. And I couldn't agree with you more. Limited downside, but such huge upside. I've been loving specifically silver purchasing, when it's all said and done, under $20 here now, with the spot price just barely sub 20. And, it has oscillated over 20 this week for a short period of time. We're kind of, you really can't buy it under. It's kind of a little more difficult to buy under 20, but in just a quick conclusion here, last question, how opportune would you say this time is to be able to buy specifically silver, for this $20 target here, this $20, with where it's ultimately going? How opportune, in your opinion, is it at these prices?
Well, anytime you can buy any commodity under the cost of production and you have some patience, it's a huge opportunity. The all-in sustaining cost of silver when oil was around $100 an ounce, about $22 an ounce now. I'm well aware of the oil price. So now the all-in sustaining cost for many of your major silver producers, and there's only a handful of them, is probably more in the $15 to $17 range. So if you can buy it, again, near what the cost a major mining concern to buy it, and you don't have you don't have all of the difficulties that entail mining concern. You know, all you have to do is go to a coin dealer and use the internet, purchase it, and have it delivered. I mean, that is a huge opportunity. And so I think that's something very, very important for people to understand, especially if they have a little bit of patience. And when I say a little bit of patience, I'm looking out probably, 2 years to 5 probably at the most. I doubt that this system as it exists now can go much longer. In fact, it's really changing, as I said, circling back, with the Yuan being part of the SDR now or in a few weeks, that changes things. And that means there'll be some dollar sells. And so the dollar is probably fairly vulnerable at this point in time, the U.S. dollar, to some downside risk. And lower dollar usually means higher gold prices. So we're in a situation where it's unraveling further. The powers that be are trying to mitigate the situation. Part of that mitigation is admitting the yuan to the IMF's SDR system. And whether or not they can maintain control or not remains to be determined. Certainly, they would like that to take place, and of course, they're orchestrating as much as they can to have that work. And it also puts pressure on China to stay within the Anglo-American empire system. In other words, the London-New York system of global control of this paper paradigm, which is based on a lie, which is that you can print wealth, that you can get something for nothing, that if you put out enough currency into the system, that everything will be wonderful and you'll be able to continue growing the economy. Of course, this is a huge lie, and that lie is starting to be understood by more and more people on the ground. Your everyday person is starting to just look out and take a hard, objective view of reality and seeing that, the physical economy is not as good as it was, let's say, a decade ago in most places.
David Morgan, if people want more of you, where would they go and what would they find?
Well, Kenneth, as you know, I've rebranded the website called themorganreport.com, all one word, themorganreport.com. Just go there and get on our free email list. It's over on the right-hand side. Just need a first name and a primary email address. We'll verify you are who you say you are. And then you will get the Riches and Resource Report that I wrote the entire thing myself, none of my staff, which doesn't really make it better. But there's 2 movies in there that are really significant. One is on the Age of Empire and how this cycle repeats and what's going on a global basis. Is something very educational that probably most of your listeners are aware of, but I'm certain they can gather more insights. That's for free in that report. And there's another movie for free in that report, and that has to do with the empty ATM, which is the currency crisis that took place in Argentina in 2000, 2001. And it's a documentary. It's not a docudrama. It's not a fiction. It's a reality. So people can see for themselves how the Argentinians reacted to the bankers and the banking system and what happened in their, what I'll call a bail-in, although that's not their terminology, but their funds were locked in the bank, and then a devaluation took place. So it's something to be well aware of, because this is a scenario that's reality, and that type of situation could manifest in other nation states in the not-too-distant future.
David Morgan, thanks again for coming on the show and giving us here an update on really just these events that are all converging. A lot of stuff going on in the next few weeks in the election. And, I'm glad we got to get your take on precious metals in the market. So thanks again for coming on.
Well, my pleasure. Thanks for having me.